sure you can hear me. Can you hear me okay?
You sound real good. You look good.
Great. Hey, thanks, Marty. Thanks for having me on here. I just want to comment about malls being mauled. I like those kind of stories when I hear them. I've been interviewed several times in the Wall Street, and Esther Fung is the real estate writer for the Wall Street Journal. I tell Esther, the more negative stories you can have about the mall sector, the better it is for my business. So we'll go into that in a little bit. My name is Andy Weiner, president of RockStep Capital, and I've been in the business about 25 years in real estate investing, and prior to that, I managed the operations for a 150 store clothing store chain. So I've got a retail background where I ran the store operations, including real estate, and then I went into shopping center investing. What I want to do is do a share screen. So Marty, will you let me know if this share screen looks like it is working? So is that working there, Marty?
Yep, there you go.
Okay. Great. Okay, so what I want to do is walk through a couple slides and tell everybody a little bit about the history of the company, what we see happening in retail, why we think retail is a very interesting space right now, two strategies that we see as viable strategies in this space, and then one example of that strategy. And then I think we'll have some time for Q&A after that. So let's go ahead and get started. So RockStep was founded 25 years ago here in Houston. That's where I'm sitting right now, as a vertically integrated real estate company focusing on the shopping center sector. We buy and operate malls, grocery anchored centers, grocery anchored shadow centers, and power centers. And the word RockStep, for those of you who don't know it, is a dance move. So I love big band era music. I like Frank Sinatra, Ella Fitzgerald, Peggy Lee, Rosemary Clooney, that 1950s, 1960s genre of big band music. And when you do swing dancing or couples dancing to that type of music, the RockStep is when you switch directions on count 7 and 8. 1, 2, 3, 1, 2, 3, RockStep. Okay. And so what it means for us at RockStep is we want to be light on our feet. We want to be able to be nimble, to be able to switch directions quickly because of either challenges in the marketplace or opportunities in the marketplace. As the music changes, we want to be able to be nimble and be light on our feet. So that's where the word RockStep comes from. We have built or acquired over 8 million square feet of shopping centers in the last 25 years, and come August, we'll be at 9 million. We have property in 11 states. We have about 22 properties, and come August, we'll add another 34 properties in 14 states. So we'll be in 21 states sometime by mid-August. And I'll give you a little more background on that. Over this period of time, we have a track record on completed assets of about 40% IRR and a 2.75 multiple. I'll show a picture a little bit of our senior team, but we average about 30 years of either retail or real estate investment. A few comments on COVID, on the COVID impact and the Amazon impact. Amazon was impacting the retail sector before COVID, and what happened with COVID is that it really accelerated the Amazon trend, and there were certain subsectors of retail that were getting squeezed. The big one is the department store sector. And so what you're seeing with the Bon-Ton, with Macy's, with Dillard's, with Belk Department Store is a dramatic reduction in sales and sales per foot in store count. And that has been affecting the shopping center sector. But what's interesting is that there are a group of growth retailers that are putting their foot on the accelerator. They have extremely strong balance sheets and they're growing dramatically. And our workload is at double its historical peak today, doing deals with TJ Maxx, with Marshalls, with Ross, with Hobby Lobby, Burlington, Aldi grocery store, Five Below, Tractor Supply, Harbor Freight, Starbucks, Chick-fil-A. These are growth retailers and fast food restaurant concepts that are taking advantage of the weakness in the market to grow into strong markets at lower occupancy costs. So this shows a footprint currently of our 11 states, kind of in the center part of the country. And I'll show you a map of the 34 properties that we're going to be buying in August, and it will show the distribution of those properties. If you can take a look at our team, averaging about 30 years of real estate and retailing experience. So we've got a seasoned team. We were doing remote management prior to COVID. About half of this team is based remotely. I'm going to actually, let me go back here. Hold on for a second. So Tim Kolterman, our Chief Investment Officer, lives in New York. Beth Isaacson-Haft, our Director of Acquisitions, lives in South Dakota. Jody Vest, our Director of Mall Management, lives in Minnesota. Racine in Missouri. So we've got distributed management. Half of our team is remote. Half of it is based here in Houston. So let's talk a little bit about two strategies. One is the mall repositioning strategy. And we think this is a great opportunity because basically most malls are bankrupt. There's somewhere, we think it's more than $20 billion of mall debt, primarily CMBS debt that's underwater. And they're either in special servicing or they're going to go in special servicing. And what's going to happen is over the next 3 or 4 years, 250 properties are going to come out of special servicing with a forced sale. They will come out at market. And our goal is to buy the best 15 to 20 of these malls and get extremely low risk, high returns. I'll talk to you a little bit more about that. So there's different ways of capitalizing on this opportunity. One is you monetize the value of the out parcels. So you basically bifurcate, you split the property into a center, we call it the carcass, and then you create value by selling off the pads, taking the key anchors, selling off the anchors at a traditional market cap rate. So you buy it cheap, you sell off the periphery, you eliminate your basis, and in some cases, you're way below your basis after you do that. Second, you right size the property for the amount of retail that's appropriate in today's market. These properties are 30 years old on average. So they were built for a retail world that was dramatically bigger, but you squeeze it down to the appropriate amount of retail. You bring in all the retailers we've been talking about, TJ Maxx, Ross, Burlington, et cetera, Aldi grocery store. And then with the rest of it, you substitute alternative uses. What are they? Office, medical office, corporate office, government office, educational facilities, fitness, family entertainment, multifamily, e-commerce fulfillment, mini storage. And you basically own your vacancy for free. And you got a great location in a good market with a great parking field. And you can become the low-cost provider of all of these different types of alternative uses. And effectively, these are covered land plays. So you're buying the property, even though you're buying them at a 20 to 25 cap, 15 to 25 cap on existing income. The value at that cap rate is the value of the land. So you have extreme downside protection, and the upside is the ability to either separate the out parcel, do both, separate the out parcels, and then create alternative uses, and you create a diversified cash flow. You're buying at 15 to 25 cap, but if you have a diversified cash flow of multifamily, of mini storage, of e-commerce fulfillment, of office, what's the value of that? Maybe 5, 7, 9 cap, but you're buying at 15 to 25 cap. That's where the value is. And finally, there is a mismatch of buyers and sellers. As I mentioned, there's 200 to 250 that are going to come onto the market in the next 3 to 5 years. There's very few buyers. There's 2 large buyers, and then there's 3 or 4 medium buyers, of which we're one of the 3 to 4. That's it. There are no other buyers in scale for this opportunity. Let's go to the second strategy, and that's value retail. And that is where properties have been hit by COVID, been hit by Amazon. These are opportunities where you might have weaker management. You can take advantage of those opportunities and really make a very reasonable return at a low risk. Let's talk about an example of what we're seeing in the value sector. We call it the Walmart shadow anchored portfolio. And let me do something here. Yeah, there we go. The Walmart shadow anchored portfolio. This is 34 shopping centers. Hold on for a second. Let's try there. There we go. This is 34 shopping centers located in 14 states, about 900,000 square feet. We have this portfolio under contract. It is being sold by a German pension fund that has held these properties for 14 years. They put it for sale right as COVID was coming in. They pulled it off the market. COVID brought some vacancy down. Traditionally is 94%, sometimes 95% occupied. It went down to 90% during COVID. They have to get it off their books. It is the last piece of real estate of investment in their fund. So they're forced to sell it. We have it under contract. Major tenants are Dollar Tree, Cato, GameStop, the ones you see here on the screen. We work with all of these tenants anyway. We operate in many of this style of markets. Most of our properties are in secondary markets. Let's go through a couple other issues. Here's the map. You can see that there's 14 states. There's a concentration in 4 states: Texas, Louisiana, Oklahoma, and Iowa. I'll go back there. So let's talk about the strengths. This is all grocery anchored shadow. Walmart is by far the dominant grocery player in this country. And these are shadow anchored to Walmarts, which are the biggest grocery store within the entire region. They average 182,000 square feet. 40 to 50% of the GLA of each 180,000 of each Walmart is grocery. And so it just drives traffic to this center. And our properties are visible to the Walmart. They're right next door on top of those Walmart in these markets. All the Walmarts are corporately owned. And again, this is grocery shadowed type of retail, which we believe is the lowest risk in all of the retail segment. 262 different tenants. So there's a diversification of cash flows. Obviously, there's a diversification of markets. We use Placer AI. For those of you who are not familiar with Placer, Placer is a very sophisticated mobile phone tracking system that analyzes how long people spend in which store. And in this portfolio, we are in about the 50th percentile of Walmarts and Dollar Trees in the state. These properties are in that 50% percentile. And because these are in smaller markets, it tells you how strong these properties are. Another feature that's unique, 70% of the tenants have been at these properties for over 10 years. There's very little variation. COVID has taken 3 or 4% of occupancy of the fleet. We believe we can bring that occupancy back up. So how do you do this? How do you create value? What's the strategy of creating value here? There's 2 basic strategies. Number 1, take the lease up from 90% to the historical 93, 94, 95%. By doing that, you add 1.26 million of NOI. At a cap rate of our purchase, that creates about $15 million of additional value. Second, you buy wholesale, you sell retail. The German pension fund is only willing to sell this as a package. If they would have sold them individually, they would have made more money, but they wanted to get rid of them in unison, make it easy, and sell it as a package. We're buying the properties at an 8.3 cap for the portfolio. We have done about 50 analysis about where these type of properties have traded. And this was before the last 60 days, because the 60 days cap rates have come down even further. But on average, the cap rates are between 7 and 8 cap for this type of asset. So the idea is to take the ones that are 100% full, 13 of them are, we'll be able to lease more of them. Those that are full, put those on the market, try to get between 7 and 8 cap on it. We've we've underwritten 8 cap, but we think we can do dramatically better than that, and then sell them over a 4 or 5 year period of time. Sell 8 a year, boom, year 1, year 2, year 3, year 4, get out of it, pay down your debt, and reduce your risk by paying down your debt aggressively. And if you do that, we come up actually with a 19 plus IRR at an 8% exit cap rate. And we think we can actually do better than that. The final 25% of the portfolio we're exiting on paper at an 8.5% cap rate. So this is a 4 or 5 year hold, the kind of opportunities you're seeing out there that would not have been available except for COVID. So that's the kind of strategy out there that we're seeing. This is going, it's a very exciting opportunity for us. It's about a $23 million raise, minimum investments, $250,000, 8 pref current. In other words, we will pay the pref 8 current. It's a 4 or 5 year hold, 19% plus IRR. And this is, I call it just boring cash flow, grocery anchored Walmart stuff that we think is diversified and as good an opportunity as we've seen out there. And we look at hundreds and hundreds and hundreds and hundreds of opportunities. So Marty, I know I want to see if you have any questions. Let me check my time.
Andy, I got a couple of questions.
Marty, shoot, I did pretty good.
So Andy, can you get off the background on Tim Kolterman? I mean, I know that you started off, and I know you from many years ago when you first started off, and you know, I know you've lifted a lot of weight, but I see that you guys have become a lot more professional. Can you give some background on Tim?
Sure. Yeah. Let me give you some background on Tim. Anything else right now, Marty? Or I'll start with Tim.
I've got some questions from the audience, but I'll give them to you after this one.
Okay, got it. So let me. So Tim Kolterman joined us about a year ago. Tim's background is 30 years of capital markets. He spent 10 years in Chicago, got his master's degree at MBA, University of Chicago, and then he spent 20 years on Wall Street. He ran the whole loan book at JP Morgan. He was co-head of global real estate for Bear Stearns for 7 years. He's been private equity since then. And so he believes that this opportunity in retail right now, which is, you know, a bit contrarian because people are fleeing retail, is a great opportunity. You can certainly try to make money at 3.5, 4 cap in industrial, and 4 to 5 or 5.5 in multifamily, but grocery anchored portfolio at 8.3, diversified with huge upside, or mall opportunities at 15 to 25 cap on existing income with vacancy upside on a relative basis. He's very excited. Now he's on a plane right now. Otherwise he would be.
Sure, Andy, and just to get back to this. So, I mean, I know that, our group has been hunting distress, since COVID started, right? Everybody thought there was going to be a stampede to distress like there was in 2008, but, several government programs came in. There's been all kinds of, let's say abatement of being able to litigate for people who aren't paying rent, mortgages, owners, et cetera. So I just want to get to a couple of questions. One of the big questions our group has said is, am I getting in at the right time, or am I catching a falling knife, right? So maybe you can talk about like the nature of your deal, like why is 8.3% cap rate on this Walmart deal a good price? Why do you think that?
It's interesting. In the grocery shadow sector, Marty, there has been a dramatic reduction in cap rates over the last 6 months because it's the safe place to be. And grocery stuff is going between 5 and 7 cap. And so the problem with this portfolio is that it's huge. There's not a lot of players who can pay over $100 million for a portfolio in retail. And so there were really 4 bidders, and they had the German pension fund out of Munich. they had to get it off their books. Their timing was lousy. And so 8.3 cap is extremely good cap for this. And you compare it to all the other sectors and the risk associated with grocery, I think it's pretty reasonable. Okay. Now it's not without risk, Marty, because if the 1031 exchange goes away, and obviously we're all affected by interest rates. If interest rates rise dramatically, that's a risk factor. Okay, I think it's a risk factor in a lot of other real estate as well, but it's something that we're certainly aware of. These properties, particularly in tertiary markets, are extremely stable. Okay, there's no new supply coming on, zero new supply coming on in these markets.
There was a question from the audience about why Brookfield and others of that ilk aren't competing with you.
Well, these companies are trying to stay alive, Marty. Okay, Brookfield, CBL's in bankruptcy. I will tell you that even Simon, I've walked through hundreds of malls. These companies are struggling keeping NOI stable, and they're having to invest more TIs than they used to, tenant improvement dollars, to keep their NOIs stable. Brookfield can't do it. They're going to try to stay out of bankruptcy. Okay, this is off the record. CBL's in bankruptcy. We know all of our competitors. Okay, and
you don't have to go any further. I'll give my comment on Brookfield. Brookfield's been a sponsor of ours for a long time. They had the Brazil fund, and unfortunately, they raised it just when the 2008 crash happened. So originally, it was a Brazil growth fund. Then it became a Brazil distress fund.
Yeah.
So these things happen. Understood.
But they can't buy their own properties. So the special servicers will not allow borrowers to buy their properties after they default.
Sure. Can you talk about the minimum equity and targeted holding period for this portfolio?
Okay, for this portfolio, and again, there's two strategies. The Walmart Shadow, minimum is $250,000. The raise is about $23 million, Marty. I will tell you, our average investors generally are $500,000 to $1 million. We certainly have some investors who do below that, and we have some investors who take pretty significant positions in our assets. For the mall portfolio strategy, right now we're buying malls in single-purpose entities. We don't have one to show, but I think in the next week we'll have one to show. There, it's the same thing. It's $250,000 minimum. Those 5-year holds, we target between 18 and 20 IRR using conservative underwriting assumptions. That's our target. And we look at hundreds and hundreds and hundreds and hundreds of deals to try to get one or two that fit that criteria. Great.
Talk about your mall repositioning strategy. How do you find deals? What's your deal flow?
The deal flow. What's interesting is the special servicers are using 3 or 4 gatekeepers to basically put the product out there. Sometimes you can buy directly from a special servicer, but most of the time they're required by their bondholders to market this publicly. So there are we know all the gatekeepers. We do business with all the gatekeepers. I've got emails from all 4 gatekeepers on my email that have come in today. So we talk to them all the time. They're letting us know, okay, I've done 75 BOVs, broker opinion of values for these special servicers. We're going to be bringing out 3 in June, and I think we're going to bring out 2 more in August. And then one of these other 4 folks is going to, we've done 30 BOVs, and we're going to bring out. And so you basically stay in touch with these guys. You try to get 1 to 2 weeks notice ahead of when they market it, so you can go study the property, you can underwrite it correctly. And then when the bids come, there's 4 or 5 people that bid. 2 people are the big players, and then there's some other people out there like us who will come in also. But there's 2 players. One player is backed by Israeli bond money. The other, both players are out of New York. They're what are called asset depletion strategists. They're very good at what they do. We operate a little bit different because we actively come in and try to substitute alternative uses for the vacancy. We actively shrink the retail, but we'll reinvest in retail if you can get credit quality tenants at a very good return.
Great, Andy. So just my last question is, and I'm going to kind of twist this a bit, because I know that we have some questions about COVID, and more retailers are becoming Amazonified. I don't know, maybe that's right or wrong. But there's a third part of this question, which is that, you know, Amazon is moving into the grocery space in a big way, right?
Yes.
And maybe they're going to, as much as they're a competitor, maybe they'll be a tenant of one of your malls in the future, right? So can you just, you know, lay the groundwork and talk about how that's evolving?
Sure. Look, for what are called digitally native brands, without a store presence, they cannot manage their cost of customer acquisition. So digitally native brands are expanding into the bricks and mortar space. That's number one. Number two, the retailers like Dick's Sporting Goods or Kohl's, they are operating their stores as e-commerce fulfillment centers. We have a Kohl's in Janesville, Wisconsin, that does over 1,000 packages a day of e-commerce fulfillment. Dick's Sporting Goods the same way. So instead of building e-commerce distribution centers, they already have their store. It can handle BOPIS, buy online, pick up in store. Okay, and so that is the highest capital opportunity in retail. It's to make your existing fleet e-commerce fulfillment centers. It doesn't mean that we're not going to lose more retail, particularly in the department sector.
Well, so Andy, let me just add another comment here. So we had Peter Lewis and Wharton Equities on. He's a professor at Columbia University Business School, and he was saying that he thinks, I think Kohl's, Amazon returns are half of Kohl's business these days in terms of like bringing customers in the door, right? And so he thinks that Kohl's is going to have problems if it loses that Amazon return service. I'm not sure if it was you or somebody else who told me last week that they think that this whole business of return of e-commerce is actually going to become something where people are going to start bidding for that business and pay to have you return Amazon goods at their store because of the amount of foot traffic it brings in. Any comment?
Yeah, I don't know if the number is 50%. I'd be surprised if it was 50%. I will tell you that returns are unprofitable, and e-commerce returns are extremely unprofitable, and digitally native brands are going to try to reduce that expense by somehow constricting returns, and I think it will force a little bit more business back to the stores. I don't know if I answered that question, but you know, Peter, I don't know if you're on the phone.
Andy, we're like out of time. Do you have any other closing comments you want to make to the group? I mean, what are the top 2 or 3 things we should take away from your presentation?
I want to make 2 other comments.
Yep.
First of all, the idea of a Walmart shadow portfolio is a stunningly boring, but really good opportunity of buying it wholesale, selling retail, which, given its diversification, you know, and hitting a 19 IRR, we think it's a great opportunity. I love any of the folks on the phone, on the Zoom, if they have an interest, to reach out to me through Marty, or you can see my email on, or you could have seen my email on the screen. Second, the opportunity to create destination retail opportunities in some of this vacant space is really going to drive some of the opportunity, particularly in the mall sector. And as a company, we created a new company called RockStep Brands to grow retail businesses. And we have 2 businesses, one, a family entertainment center, a super center concept, which we've already opened up. One of these are very successful. We have another one, it's a home decor craft concept of 40,000 square feet. And we plan to grow these as a retail concept, not just in our properties, but as a retail growth vehicle, given all of the amount of real estate that exists at a very low price. My retail background combined with our real estate knowledge, I think creates another whole set of opportunities, but that's a discussion for another day.
Sure, Andy, and I hope that the audience follows up with you. Right now, I think about 25% of the audience has downloaded your presentation, so that's really great. So Andy, great job. Thanks so much.